Welcome to Accounting with Madam Mombi. So today we are going to look at cash budget. You should also check a video. I have already done the master budget, some of them. It is also part of the master budget, the cash budget. We are going to start by defining what is a cash budget. A cash budget is simply, as the name suggests, a budget for cash. So it is a record of the expected or projected cash inflows and cash outflows that are expected to take place in respect to a certain period of time. So you can prepare a cash budget for 1 month, 1 week, 1 quarter, or any other period, projected budget period for which you may have interest to see how much is the expected cash inflows and the expected cash outflows. Now, why are cash budgets important? An organization has to ensure they have enough cash to meet short-term obligations. So at all times, a cash budget is prepared to ensure you either do not have excess cash in the organization, or you do not have too little cash in the organization, such that you're not able to meet your short-term obligations when they fall due. So a cash budget, it ensures that sufficient cash is available when required. Also, it helps you to plan how many capital expenditures or investment in fixed assets or a form of capital expenditure that would form any commitment of funds to projects, such that how many of them can be financed internally because of the cash projection and how much of them can be financed through borrowing. It also indicates the cash needed for operating activities. So the normal day-to-day operations of the business require cash. Therefore, you need to do a cash budget to indicate how much money you have for your operations. It also helps you to be able to project the requirement of cash for items like large stocks, unusual receipts, and it can also help you to detect areas where you are lagging behind. Like for example, when you are projecting your cash inflows and you realize that the debtors are not paying in time, so you realize that there is a problem with managing the debtors, then you can take it upon to management to be able to look at how to improve the collection of accounts receivables. Also, it indicates the availability of cash for taking advantage of discounts. So sometimes the organization may want to meet their creditors, to pay their creditors on good time, or they may plan also to buy via cash instead of buying via credit, where they have enough available cash. Therefore, they can be able to benefit from cash discounts and so on. So again, it also helps us to see where there is available excess cash. And when cash is excess in an organization, it is not good because it means you are holding on and giving up investments. So holding cash that is not generating any revenue is detrimental to the organization. So having a lot of excess cash means that once you identify there is excess cash, you can be able to determine short-term investments that are going to be considered, and you invest the money in those short-term investments, and eventually you get a return. So these are just but part of the benefits of a cash budget. You may read on them and internalize on them and be able to get an understanding of why you require to have a cash budget in an organization. So for our class, our focus is mainly on how to prepare a cash budget. So I'm going to go ahead and give you a question here which we can use to prepare a cash budget. So allow me to zoom into the question. Our question is that ABC wishes to arrange credit facility with its bankers during the period of April to June 2024. The following information is available for the 6 months of the year 2024 from January, February, March, April, May, and June. You're given some are actual that have already happened, and for the April, May, June, we are projecting the budget. And that is our budget period. So this is a quarter, the second quarter of the year, whose budget we are preparing. So the information that we are given the first information is on the purchases in cash that were made or that are projected to be made. So the purchases are given there, you can see, for every month. You're also given the wages in shillings for each prospective month. Also, you're given the sales in shillings for each prospective month. And finally, you're given the expenses. So from this information, we are supposed to prepare a cash budget. Simply, as we have said, a cash budget is a projection of cash inflows and cash outflows. And if we were to look at this, purchases represents a payment to the organization. So purchases represents a cash outflow. When you look at wages, again, it is an expense to the organization. It represents a cash outflow. But when you look at sales, they represent a cash inflow. This is money coming in to the organization in form of cash. And we are going to look at how this money is going to be received from the sales. And finally, expenses represents a cash outflow. So this information, if the question did not have additional information, would be pretty straightforward. But now we have to look at the additional information about these entries. So specifically, we have been told that all purchases are on credit. So everything that has been bought by the organization has been bought on credit. So we are going to look at how then are they going to be paid. Then you are told, and 20% of the sales are for cash. So out of all the sales that are represented in this question, which we are going to come to, 20% of those sales are for cash, meaning that the money is going to be received in the same month as the sale. You sell this month, and 20% of that money is received in that month. So 20% of the sales represent cash sales, meaning they are received in the same month of sale. Then you're told 50% of the credit sales are realized in the month following the sale, and the remaining 50% in the second month following the sale. So if you remember, if 20% of the sales are for cash, it means that 80% of the sales are on credit. That is, you have sold to people who have not yet paid. So the 80% of sales that are on credit, they are going to be received in 2 installments. The first installment, which is 50% of those credit sales, shall be received in the month following the month of sale, and the remaining 50% in the second month following the sale. So if a sale occurred in January, 20% will be received in January because it is a cash sale. The remaining 80% of the sales of January, the remaining 80%, you are going to apportion into 2 portions, 50-50. 50% is going to be received in February, and the other 50% is going to be received in March. That is what this information is telling us, and we are going to see that. Creditors are paid in the month following the month of purchase. So as you are told that all purchases are on credit, they are paid 1 month lag. So that the purchases of this month are paid in the next month. The purchases of the next month are paid in the next month. So they are 1 month in lag, or simply creditors are paid after 30 days. So they are going to be paid, the creditors of this month are going to be paid the next month, and so on. Wages are paid in their respective months. For wages, we are going to pay everything in the respective month. Then you are told there is a monthly overhead to be incurred of shillings 5,000, of which 2,000 represents depreciation expense. Now, overhead costs are indirect costs. We are being told they are going to be paid 5,000 or incurred 5,000, out of which 2,000 represents depreciation. So the important information here to note is that depreciation does not represent a cash movement. Depreciation does not appear in the cash budget because it is not an out-of-pocket expenditure. There is no money that we take from our pocket to pay. That is called depreciation. So depreciation is a non-cash item. It shall not be present in the cash budget, and it represents an implicit expenditure. Rather, it is not explicit, meaning it is not an out-of-pocket expenditure. Taxation of 2000s will be settled in June, and the company will receive shillings 25,000 from an insurance claim in April. So what we are required to do is to prepare a cash budget, as at 1st April 2024 is expected, cash balance as at 1st April 2024 is expected to be 15,000. Remember, our budget period is from April to June. So this is the opening cash balance. And finally, you are required to prepare a cash budget for the period of April to June, showing all the working. So allow me to first of all, let's look at this information, because major of our workings are going to be from this information. Then I will turn to the board. So we are going to start by thinking of the format of the cash budget. Our budget period is April. We are going to have June. No, April, May, April, May, then June. April, May, then June. We are going to start with the opening balance. So we are going to start with opening balance. Opening balance. And you have seen that the opening balance, the cash is expected to be 15,000 for April. That is the opening balance of cash, as we have been told in the last additional information from the question, the last additional information. Then we are going to look at the receipts or inflows. We can leave some space there for the inflows. And then we are going to have the payments. Payments. Finally, we are going to have the balance carried down, or the closing balance here. Closing cash balance. So the format of our cash book should look like that. It should have this opening balance. It should have all the receipts, all the projected receipts, and finally it should have the closing balance. So now I want us to analyze the information in the question. We are going to analyze the information in the question. Let us pick this information. Let us look at, let's start with the receipts. We are expected to receive money from sales. So, in the month of January, they made a sale of 80,000. In the month of February, they made a sale of 80,000. In the month of March, 75, 90, 85, and 80. These are the sales. From these sales, you have been told that 20% of the sales are for cash. So, 20% of 80,000 was received in January because it was for cash. 20% of the sales of February, of again 80,000, was received in February. 20% was received in March. 20% was received in April. So, our interest for the budget period is April, May, and June. So, the 20% that was received in January, we have no interest. February, March, no interest. Our interest is that out of 90, 20%, out of 85, 20%, and out of 80, 20% for this budget period, they are received in their respective months because they were on cash sales, cash basis, meaning they bought for cash and received the money immediately. So we can see that from this, we are going to compute 20% for each and say those are the cash receipts. So coming back again, coming back to our solution, we can say that there were cash sales, which we have said is 20% of the respective months. So the cash sales for respective months, for April, we are saying it is cash sales of the sales of April. 20% of the sales for April is 18,000. 20% of the sales for May is 17,000. And 20% of the sales for June is 16,000. That is the information that we are getting from that first information there. Then we can come back and, to the question again and see. So the remaining 80% of all these months, the remaining 80% shall be received in 2 consecutive periods. Because you are told that 50% of the credit sales are realized in the month following the month of sale, and the remaining 50% in the second month following the sale. So again, let us do a working for that. Let's do a working for that. So we are going to see that in January, the credit sales is 80% of the sales. So the credit sales were 80% of the figure for that month, which is 64,000. These credit sales are going to be received 50% in the following month. The month following January is February. So for February, we are going to receive 50%. And the month after, which is March, we are going to receive the other 50%. So 50% of 64,000 is 32,000. So that means that in February, they are going to receive 32,000. In March, they are going to receive 32,000. Now, this is not in our budget period. So February and March are not in our budget period. So that information does not assist us in our budget. So let us look at the sales for February. 80% again of 80,000, giving you 64,000. But this time it is going to be received in March. The month following February is March, and the other one is April. So again, 32,000 and 32,000. But now April is in our budget period. So that one we are going to account for it because April is in our budget period. We are going to do the same for all others. So we are going to look at the ones for March. 80% are the credit sales, which is 80% of 75,000, which is going to give us 60,000. And you are saying it is going to be received in the 2 months following the month of sale. So it's going to be received again in April and May. So 50%, this is going to be 30,000, and the other one is going to be 30,000. And both April and May are in our budget period. The sales for April, it's a bit repetitive, but we have to do this because we have to apportion all the credit sales. 80% times 90,000. It's going to be 72,000. Again, this is going to be received in the 2 months following the sale, which is May and June. May and June, we are seeing that then 72,000 divided by 2, which is 50% for each, is going to be 36,000. Again, these 2 periods are part of our budget. We are going to do the same for May, and we are going to do the same for June. So for May, we are seeing that it is 80% times 85,000, which is the credit sales. The credit sales is going to be 68,000, which again is going to be received in the 2 months following May. The 2 months following May are June and July. So they're going to be received in June and July, 34,000. 34,000. The sales for June are 80% times 80,000, which is 64. But they are going to be received in July and August. July and August. So you can see these periods are not in our budget. Same as these 2 periods are not in our budget. These 3 are not in our budget. So the ones in our budget, even this July is not in our budget because our budget period is April to June. So we are only interested in what was received in April, or not received, sorry, we should say projectively, because you're making a budget. What will be received in June, what will be received in May, what will be received in April. So from this, we can be able to see how much is going to be received in April. This is April 32 and April 30. So the total receipts from credit sales in April are going to be 62,000 for April. The total receipts for May are going to be 30 and 36. 30 and 36 is going to be 66. And the total receipts for June are going to be 36 and 34. 36 and 34 giving us 70,000. We are not interested in July. So the credit sales are going to be broken down into this, and eventually we are going to only pick the ones that are going to be received in April, the ones that are going to be received in May, and the ones that are going to be received in June, because those are the ones that we are interested, which is 62, 66, and 70,000. So we can go back to our previous slide with this in mind and come back here to our receipts and say proceeds from debtors. Remember the people to whom or accounts receivable. Proceeds from debtors or accounts receivable. So you can also say receipts from credit sales. You can call it any name as agreeable. So proceeds from debtors, proceeds from accounts receivable. We have seen that in this period you are going to receive 62,000. In this period you are going to receive 66,000. And in this last period we are going to receive 70,000. So we can check whether in our question there was anything else that we were supposed to receive. So from our question, we can see whether there is anything else we were expected to receive. Because as we said, this column is a payment column, because when you purchase, you have to pay. So that's an outflow. Wages, you have to pay, that's an outflow. Only sales were an income. So it's only money from sales that we can receive, of which 20% was cash sales, and 80% was credit sales, and we are going to receive in the formula that was given here in additional information number 2. These are expenses. So the other thing we have here is on additional information number 5, it says taxation of 2,000 will be settled in June. We're not going to forget that. And the company will receive shillings 25,000 from, the company will receive shillings 25,000 from an insurance claim in April. So we can see it is specifically told this is not an amount that is received every month, but you're going to receive in April 25,000. So we can go back to our question and say that it is expected from insurance claim, we are going to receive in April 25,000. And there is nothing else that we need to receive from our budget so far. So therefore we can get the total receipts. We can get a column for total receipts. Note that you're not going to include the opening balance. You don't include the opening balance. Just add the column for total receipts. Add the column for total receipts. So the total receipts here is 105,000. The total receipts here is 83,000. And the total receipts here is 86,000. And after that, we can go to the payment. So again, we are going to go back to the question to look at the payments. And we are going to start by looking at the purchases. So the purchases for January, we have been told, according to this information, is that creditors are paid in the month following the month of purchase. Meaning, if we purchased in January, we are going to pay in February. So the purchases for January are paid in February. The purchases for February are paid in March. The purchases for March are paid in April. Those of April are paid in May. Those of May are paid in June. That is 1 month lag. So what we are going to do is that, because our budget period is April, May and June, we are going to determine what was paid in April, May and June. In April, we paid the purchases of March. In May, we paid the purchases of April. In June, we paid the purchases of May. So in our budget, our interesting figures are 42, 50 and 45 respectively. So those were the ones that were paid during our budget period of April, May and June. So coming back to our answer, we are going to say payment to creditors or payment to suppliers, payment to creditors. In May, we are going to pay the purchases of March. In April, we are going to pay the purchases of March. In May, we are going to pay the purchases of April. In June, we are going to pay the purchases of May. In that order. Then we can go back and see that we have seen in our question that wages are paid in their respective months. So for the wages, we were told that wages are paid in their respective months. So the wages are paid in their respective months. So for these ones, we are going to pick the ones for April, May and June, our budget period, which is 24, 20 and 18. Each in their respective month is the exact same month when they are paid. So we are going to have here 24, 20 and 18. 24, 20 and 18. They are all paid in their respective months. Further, you are told that there was an overhead of 5,000 that is going to be incurred per period. But the overhead has a depreciation in it. Inside it, there is depreciation of 2,000. And I've already explained that depreciation is not a cash movement. It does not represent out-of-pocket expenditure. So the overhead, out of 5,000, we are only going to expense or outflow 3,000, the one that represents a cash movement. So 2,000 shall not appear here because it represents depreciation, which is not a cash item. So for the expenses that are given here, that is 5,000, 6,000, all these expenses, nothing much is said about them in the additional information. In that, we can then assume that the expenses are paid in the respective month. So for the expenses, we are going to pick the 3 for the respective months. But if there was some information telling you otherwise, that maybe they are apportioned or they are paid 1 month in arrears or 1 month in lag, then we would implement as we have done with all the other items. But now, since nothing is said about them, we are going to just include them in our budget per the respective months. So the expenses here, we are going to pick for each month. So for the month of April, we have 7,000. For the month of May, we have 6,000. And then finally have 5,000 respectively. Then remember, we said that there is a taxation of 2,000 that is going to be paid in the month of June. So in one of the additional information, it is said there is a taxation of 2,000 to be paid in June. So now, as we did for the total receipts, we may also here get the total payments. Total payments. So the total payments are all the payments that are going to be made, which is going to be 76,000. Here the total payments are going to be 79,000. And here the total payments are going to be 73,000. Once you have included all the payments. So for us to get the closing balance, we are going to say, assume that the opening balance is given as A, total receipts is given as B, and total payments is given as C. The closing balance is going to be A plus B minus C. In short, it is going to be the opening balance plus all the receipts minus all the payments. So giving us in the first period, it is going to be 15,000 plus 105,000. You subtract 76,000, giving you a total of 44,000. That is the closing balance of the first month, April, in our budget. The closing balance of April shall be the opening balance of May. So the closing balance of April becomes the opening balance of May. So we are going to get the 44,000 to be the opening balance of May. Again, we are going to add 44,000 plus 83,000. We subtract 79,000, and we are going to get that to be 48,000. And the closing balance for May is going to be the opening balance for June. So you can see here now, this is going to be the opening balance for June, which is 48,000. So again, 48,000, you add 86,000, you subtract 73,000, that you get the final closing balance for the month of June is going to be 61,000. And that is how you prepare a cash budget. That is a budget that shows the opening cash balance, all the cash inflows and all the cash outflows, and finally gives you the closing cash balance. So if you found this video to be helpful, kindly like, share and subscribe. Thank you.